Julian, so you don't believe that that June 17th low on the S&P of 3636 is indeed the low for the year. Rough Q3, maybe some rebounding in Q4?
Very consistent seasonal type patterns. And again, we were heavily endorsing the rally back in June and July, but as is extremely typical and stranger to a bear market rally, you actually see uncertainty increasing. At the same time, FOMO has set in, whereas back in June, there was lots of fear. Put it all together, and when you think about the data that we just saw at the top of the hour, it's very clear that the Fed is going to stay resolutely hawkish against the backdrop of, look, this is clearly not a recession by all conventional means, but it's very slow growth, and that's a difficult combination for stocks.
Where does this current complacency come from? Because I was reading a recent note where you talk about the market becoming too complacent in the wall of worry. And you're right about the wall of worry out there. We've got geopolitical risks. We've got monetary tightening out there, rates increasing, potential softening in the labor market, little evidence of that. 2 consecutive quarters of negative GDP, and the market kind of just shrugs it off and says, whatever. Is that just kind of a end of July, August phenomenon? Do you think things will change in September?
So when you think about the evolution of 2022, 2 key things. First off, professional investors de-risked the minute they started getting concerned about Russia's invasion of Ukraine and inflation spiking. The public was a little slower to sell. The public did sell in April. But all of a sudden, if you go back to the June FOMC meeting, you've had yields fall, and stocks have responded very positively to that. From where we stand right now, particularly given the data, again, that we've seen at the top of the hour, the fall in yield story has likely run its course. And that, too, is a headwind for stocks. But the options market is telling you that people just aren't really concerned about too much. And I think you could easily make the argument that some of the activity we've seen in the last several days shows that the meme stock traders' population may have dwindled, but they're still there. And that, to us, is much more typical of sort of late cycle August coming into September, which is tends to be a dangerous month type of behavior.
That's interesting. You mentioned the data at the top of the hour. Earlier in the week, it was ISM manufacturing prices paid, the 4th biggest month-on-month drop in the history of the series. Today, it's services, biggest monthly drop since 2017. We're going to start to hear a lot more people argue that Jackson Hole will be an opportunity for the Fed to truly pivot. You think that's also too optimistic?
Yeah, we do. Now, the positive, and we'll say that Ed Hyman and his team's surveys have shown conclusively that pricing power has started to turn. And that's a major positive in the battle against inflation. But there's clearly much more work to be done. And the Fed has really made it clear that the last thing that they want to do is get into a position where, for some reason, they have to cut rates subsequently in 2023 simply because the inflation problem may not have been cured. So there is more work to be done in terms of hiking before we sound, more of an all clear, particularly for the equity markets.
Shepard Smith here. Thanks for watching CNBC on YouTube.